If you've looked over the ocean to America lately, you'll see that their markets are practically on fire right now. Inflation is over 7% for the first time in 40 years. Markets have been sinking to its worst start since 2008, and you watching might even have some US stocks in your portfolio that have turned red. So what on earth is happening, and do you sell everything immediately, or do we take advantage of the fire sale and buy the dip? That's what we're going to be talking about in today's episode, so stay tuned. Since we started this channel, the markets have been pretty much smooth sailing, but right now a storm is sweeping its way through the global markets, and it can be scary for people who invested recently and are seeing red in their portfolios. But what comes to mind is one of the richest men in history, Nathan Rothschild, who once said, "Great fortunes are made when the cannonballs are falling in the harbor, not when the violins are playing in the ballroom." So we're going to break down why this is happening, the latest news, and whether I'm looking to sell, hold, or buy more overseas stocks on Easy Equities. So welcome back to Casual Cash. Let's get started. First things first, what is going on right now? Well, remember back in March 2020 when the world went into lockdown, many people thought that civilization and the world economies might collapse altogether. It was then that the US Federal Reserve swooped in and took action. They decided to lower interest rates to 0%, and interest rates affect everyone. It could be directly by your car and home loan, or in the price of the products that you use, as the companies pay less and give the savings to customers. So when they moved the interest rate to 0%, it was to encourage people to spend money, take loans, and buy assets to keep the economy moving. Because when people aren't buying and lending money, businesses collapse, then people lose their jobs, and the downward cycle continues. So to help this, the central bank started buying $120 billion of treasuries and mortgage-backed securities, so if people needed money, it was there. Well, as they expected, people spent money, bought houses and cars at low rates, and the economy churned and recovered and eventually hit new highs. Due to the laws of supply and demand, asset prices such as houses soared because there were so many people in the market looking to buy homes on a 0% base interest rate. At the same time this was happening, COVID was taking its toll and delaying shipping into the country. There were cargo ships that were stuck for weeks and even months at sea that couldn't dock, and shipping costs were rising because of that, and the cost was being passed on to the companies and the products they sell. To add onto it, the US is currently experiencing a labor shortage. That means in order to keep people in their company and get the work done, they're paying people more to keep them on and keep them motivated. Great for those employed, but again, those extra costs eventually come to the consumer. So all of that together, the higher property prices, cheap debt, increased shipping and labor costs, and price raising at the shops lead to what this whole thing is about: inflation. Basically, it means higher prices for everything, and people paying more and more for basic items which the government doesn't want. So just as the Fed stepped in March 2020, they're stepping in again, but this time to bring things back to normal. If you invested in any US shares last year, like the S&P 500, the Nasdaq 100, or even big tech stocks like Tesla or Facebook, you'll know that prices did really well. To this day, we have all of them, and they did very well. But staying in pandemic mode as the world normalizes isn't sustainable. That brings us to part 2 and why the markets are crashing. It also takes us closer to whether we should sell everything or buy more. Part 2 is now about raising those interest rates. So why are prices going down? Nothing has happened yet. Well, people are anticipating the central bank to start raising interest rates, which means things are more expensive for businesses, especially those with high debts like a lot of big tech. So the Fed also can't keep buying $130 billion of treasuries each month forever. So people are fearing that the Fed will start raising rates and stop buying treasuries, and that fear is what's driving the market down. Rightly so. There was honestly too much growth last year, and this is a reasonable and necessary correction to bring things to normal. But now on Wednesday, the chairman of the Federal Reserve, Jerome Powell, addressed the nation, and he said all the right things, that they were looking to slowly raise the interest rate, slowly pull back stimulus, and that the market could gradually adjust until normal. That is, until he was asked about the current stance, where he said that since the December meeting, I would say that the inflation situation is about the same, but probably slightly worse, leading people to fear maybe rates will be raised higher and faster than they thought. the market went down to close the day in a negative. So that's where we are now. The US markets have been dropping steadily for a month, and even after the Fed address, they haven't gained much. Okay, so that's the American economy roller coaster. But let's get back to the real world. What does this mean for South African investors? Well, there are many ways to invest in these markets. For me on Easy Equities, I have S&P 500, Nasdaq 100, and the S&P 500 Infotech. There are a few others, but those are the main direct investments that we can make. Now, when crazy things are happening, I like to take a step back. Markets are often driven by panic and greed, but when you take a longer approach to investing, zooming out always gives some perspective. Let's look at the S&P 500. This is what's been happening the last week. Last week down about 3%, in the last month down about 10%, but if we go out to 6 months, only 2%, and as soon as we go to the 1 year returns, we go up to plus 14% gain. 5 years we're at 88%, and if we go to the maximum, well, you can see for yourself. It's important to see that there have been lots of dips over the years. Even the huge 2008 crisis was improving by January 2009. And that brief drop that you can see right there from February the 14th to March the 20th, that was the COVID pandemic before the market went up 106% by December. The Nasdaq was a bit more of a drop with debt-heavy tech companies, but once again we go to a year out to 5 years and the maximum, we see a stronger, bigger picture. So my thoughts are that as time goes on and markets reach certainty on when and what the interest rates will be, then we'll see the market start to get traction again. The big question is, when will that be? And I don't think I or anyone can really answer that question. But to be prepared, I've deposited money on standby, and as time goes on, I'll be looking to see when the market starts to pick up momentum, and I'll then look to buy into some S&P 500 and Nasdaq index funds. Because if you're investing for the long term, the prices should even out and eventually make you gains, like we see on the zoomed out graph. The best thing we can do is not try too much to time the market, but invest consistently, and we'll see some discounts and high prices, but overall a good gain and building of wealth. So that's it for today's episode, guys. I hope this shed some light on what is happening with the US and maybe your own personal stocks. And please feel free to like the video, and I'll definitely be keeping you updated on if and when we buy into these stocks. So if you want to see that, be sure to subscribe to the channel. I also have some really exciting stuff coming up. But until then, I'll see you guys next time. Cheers.